Warning to investors, contribution margin does not equal profit. Startups and financial reporting. This is Ken Boyd with the Accounting Accidentally website. And I saw an article that frankly really struck me. We're looking at the Accounting Accidentally site. This is a blog post that I wrote recently called Warning to Investors, Contribution Margin Does Not Equal Profit. And I mentioned here that, we're in a crazy political period. It's hard to know just what is true in a political ad and what isn't. But we don't have that in the investment world, in the accounting world, because we have extensive rules on disclosure. And those rules are in place to make sure that people can make informed investment decisions. However, I was really blown away by an article about startup firms talking about the fact that these firms generated contribution margin and implying that contribution margin equals profit, and it doesn't. And the purpose of this video is to talk about that difference. So, contribution margin is defined as sales less variable costs, and it's important to understand here that it excludes, in bold, it excludes fixed costs. So here's a simple example. Fancy Garments makes a line of jeans. They sell for $80 a pair. They incur variable costs to buy denim material for the jeans and labor costs to run the sewing machines, perform other manual work. So let's say in this example that the variable costs are $50 a pair. So Fancy Garments' contribution margin is an $80 sale price less a $50 variable cost, or $30 per pair. You'll notice that fixed costs have not been mentioned yet. So what other cost does Fancy Garment have to cover? Well, they've got a fixed cost to lease their factory location. They've got to insure, I need to change that from an E to an I, insure the machinery and equipment that they own against loss, just to name a few. Let's assume in this example that the fixed costs for Fancy Garments are an additional $10 per pair. We allocate fixed costs based on some sort of allocation rate. We're allocating overhead. So somehow we're getting those costs attached to each pair of jeans so we can properly price our product. So the true profit for Fancy Garment jeans is $80 in sales less the $50 in variable costs less $10 in fixed costs. Our real profit is $20 per pair. And the way we got there is to use a very common formula: sales less variable costs less fixed costs equal profit. You can set the profit to zero to figure out break even, or you can set a specific dollar amount, say $10,000, to figure out something called target net income. In other words, the starting point for figuring out the profitability of your product and how much you need to sell is to cover all your costs, which gets you to a profit of zero. That's what the break-even formula is. You can also define contribution margin this way. It's the amount you need to cover fixed costs, and whatever's left is your profit. So if you have $1.5 million in profit and $1 million in fixed costs, you need to subtract the $1 million in fixed costs to get to your true profit after fixed costs. That's my point. This all rolls into setting a sale price. The objective of placing a sale price on a product is twofold: to recover all your costs and to generate a profit. If you don't, and this is so critical, if you don't include all of your costs when you price your product, you're not going to have the profitability level that you think. So it's this Bloomberg article that I thought was so interesting over here. And what they talk about is how some startup companies are marketing themselves, their financials, to get more fundraising, to go to venture capitalists, private equity firms to get more money. And it goes through a discussion of how the company worked hard to get a contribution margin that was a positive number. But that's not profit. And the article goes on to talk about, and I've got the quotes over here, to project a healthy business to skeptical VCs, companies started shouting to the world that they were profitable, but by different definitions. cash flow positive, other terms used to describe profitability. But the problem is that all these terms were not taking into account the allocation of fixed costs and the fact that the companies were not covering all of their costs and generating a profit. So what's the big deal? Why do we go through this discussion? Because for a successful company to be viable over the long term, they've got to generate consistent earnings from their operations. So if you make blue jeans, you need to generate earnings from making blue jeans. If you happen to sell a building for a gain, that is a non-operating gain. That's not something you can replicate every single month. So as an investor, ultimately, we need to look for companies that can consistently generate earnings. And if you're generating earnings, that means you're covering all of your costs. So that's our discussion of contribution margin not being profit. You can go to the Accounting Accidentally site and find the personal finance webinar, links to my YouTube videos, other helpful tools, and all of it can be found on the Accounting Accidentally website.